Okay.
Yeah.
Good afternoon, everyone, and welcome to our viewers online as well. My name is Michel Hanouch. I'm from CGAP. I lead our work at the intersection of climate adaptation and resilience and financial inclusion. So I focus on financial service providers, predominantly MFIs, and do some thinking around what can they change in terms of their strategy, their risk management, risk assessments, and their products. I'm joined today by three great colleagues. On the left-hand side, we have Ndumiso. He is from Vision Fund International, an insurance advisor, but he has also spent a lot of time working on their recovery lending programs, including in Malawi, where we spent some time together. In the middle, we have David from Atram. David will speak a little bit around a contingent line of credit, which I think he describes his company as a climate fintech. It's super interesting, and he brings in AI on top of basically to allow the financial service providers to lend into disasters. And then lastly, we have Tamara from Oxfam Novib. Tamara is a senior investment manager and is one of the kind of leaders in this space in terms of thinking about resilience, and we'll speak about three specific tools that they offer their MFIs to enable them to build the resilience of their customers. Maybe just a couple of other things. I think, why the word iterating? So for us, we've done a lot of work over the last couple of years thinking about, like, are there completely new products that are required? How should we be thinking about this? And one of the things that has come out is, like, a lot of the tools are already being used to build resilience. So a lot of, there are customers out there, we don't measure it particularly well, so a lot of us don't know how the loans we give out are being used, but there is already financial services driving resilience. But we think that there's more that can be done, and that's kind of where we're focusing. What are the changes that are required? The other thing I did mention, so David brings that nice kind of combination between microfinance on the ground that Ndumiso will talk about, and kind of really hands-on, really people-centered, and then how do we leverage AI to kind of take it to the next level? What can we do around that? I'm going to start with 3 points, and then I will hand over to our speakers. So the first point I want to make is that climate change is undermining financial inclusion. So together with Pakistan Microfinance Network, earlier this year, we interviewed, or we did a survey with the microfinance industry, and the results were a little bit concerning, to say the least. So of the MFIs that responded, 47% of them had reduced lending in a specific geography. 1 in 5 of those had stopped lending into that geography. In addition, there was 40% of them that had reduced lending to specific sectors, with agriculture and livestock being the biggest two of that. So that's the first point. The second point I want you to walk away with is, we don't think it has to be this way. We don't think that financial service providers have to choose between their organizations and their customers' well-being. We think that there are some specific win-win opportunities, and the examples that we'll give you today is one of those examples. The way we think about it is around balancing. So we've kind of tried to iterate a little bit on Stephen Covey's framing, which basically says that in an interdependent relationship, anything that's not win-win over time tends to go towards lose-lose. So the example in Pakistan is what we're seeing, where you focus on collections and you avoid some of the risks. And that obviously has consequences for customers that are relying on these financial services for the resilience. On the other hand, on the top left, we see mission-driven organizations that are going in and really trying to prioritize customer well-being. And what the kind of message we have there is, are you doing the work beforehand that enables you to have the liquidity in place? So things like contingent credit for your organization, or portfolio level insurance, or other tools that you can use to make sure that you're ready to do that. And then where we're kind of working towards is this top right. So what does that balance look like between really kind of prioritizing your customers, but making sure your organization is just as resilient? And we think there's a feedback loop here that we're trying to work on. So really kind of, how do you think about your customers' resilience as part of your own resilience as an organization? And then the third point that I wanted to make, and this is really kind of the core of today's discussion, is that ex-post liquidity excuse me, is critical for customer resilience, and it can be delivered profitably. And I think this has come out basically like a lot of what we know about customers today is that they face a number of challenges. Climate is one of those challenges, and the consequences and the probability of each are not well understood. So to prepare for an event ex ante is difficult, and it creates risk in and of itself. And so the fungibility of solutions really becomes important, and that's where the two products that we focus on today come into play. So the first one is recovery lending. That's Ndumiso is going to talk about that now. And then the second one, which David will talk about, is contingent line of credits with a little bit of a twist. Just to pull out kind of a couple of points here. The one is that recovery lending is really unplanned from a customer perspective. An event happens and your microfinance institution comes in, looks at how badly damaged you were, looks at your opportunities for production, where you can kind of really invest and continue to earn an income, and then how financial services can play a role in that. It's really human intensive, so you really have to kind of be close to your customers in order to do this well. I think the term that I've heard some of our colleagues use is it's microfinance done well. Really a change in mindset. The second one, contingent line of credit, it's prearranged and it's fast and it's trigger based, and it's not kind of a specific amount for a specific customer to meet a specific need. It's predetermined that says when this trigger happens, you will get access to a certain amount of money. So a lot of the work is done beforehand. For both of these, capital planning for the financial institution is important. So making sure that you're ready to step in at the right time is critical. So with that, I'm going to hand over to Ndumiso. You're welcome to sit there or to stand.
I think I like to sit here, and then I'm at the same level with the rest of the group. Thank you very much, Michelle. I think, as you already see, my name is Ndumiso Mbofu. I work for Vision Fund International, and I want to talk about recovery lending myths and beliefs. Based on our experience in multiple geographies and multiple disasters, we have piloted recovery lending, and we have proved that there is a lot that we can learn from these pilots. And our recovery lending has actually been born out of the need to see that there is a challenge that climate shocks and disasters often force MFIs to reduce lending and restricting access to finance. And yet, this is the time when our clients need us most. And we have actually seen that recovery lending provide fast, flexible, and affordable loans and enable communities to rebuild. And we also see that they contribute to climate resilience because it helps our clients to get back to their feet immediately after disasters. So today I'm just going to talk about a few points, about 3 points in terms of the myths that MFIs believe when we are talking about recovery lending. Yeah, we can go to the next slide. The first myth that I want to talk about is that MFIs believe that lending to disaster-affected clients is throwing good money after bad money, to say there is no longer, these clients are no longer credit worth. But we believe at Vision Fund that good clients will always remain good clients even in difficult situations. All they need is to be facilitated to recover. And we have evidence from various pilots that we have done. In the pilot that we did in 3 countries in Africa, where we responded to the El Nino in 2015, which was a combination of droughts and floods, we actually got 97 repayment rates from recovery loans. And this was even much better than other conventional lending that we were doing. So this is proof that, yes, indeed, good clients can always remain good clients even during times of disasters. And we also see that in countries, from Typhoon Haiyan we had in Philippines in 2013, we had far below 5% on the recovery portfolio compared to 8 to 10% of rescheduled loans in other areas. So we think we can actually also see growth following recovery lending. we see more clients coming through, and we have Kenya as an example where we saw portfolio growing by 82% in area where we provided recovery lending. So the key insight here is that disaster don't erase good credit behavior of a client. Next slide, please. And the second myth that we need to look at is, should MFIs stop lending and focus on collections when there's a disaster? We are saying no to this. Forcing collections on clients will make clients run away from you. As soon as they see a vision fund car coming, they disappear and they start hiding. But if you come with recovery lending, you'll see clients coming forward. We have experience where we are actually telling clients that if you have repaid 50% of your loan, you are entitled to a new loan of recovery lending. And that actually sometimes drives repayments, because they know that if I repay, I will get another loan and I will be able to cover both loans at the same time. So there's a stronger portfolio recovery as if we compared to, and lower write-off when we actually implementing recovery lending. Clients need capital to restart, and restructuring and rescheduling is not enough on its own. Next slide, please. And the third myth that I want to talk to is that there's a belief that people have already borrowed, and if you give them another loan, that will lead to over-indebtedness. Our evidence has been validated by external evaluators like Tango and also Asia Development Bank, and it has actually shown that there's stronger resilience, and 89% of recovery lending clients were able to partially or fully repay their loans. So we see that in reality, recovery lending enables clients to clear their loans, the old loan and the new loan, and it actually enables them to restart their business, which actually creates capacity to repay loans. So again, we are saying recovery lending should be carefully done. It's not just adding debt, but it's actually helping to rebuild the capacity to repay loans. So we believe that this can help clients to rebuild their livelihoods and rebuild their businesses. Maybe in summary, let me just give you my last slide. We think recovery lending should not focus on previous earnings from a business, but you should rather assess clearly the future earning potential of the business proposed by the clients. And timely liquidity is essential. I can give you an example. In Myanmar recently, there was an earthquake, and we actually were able to start recovery lending 7 days after the earthquake, because we have a contingent credit available to support that process. And we catalyzed the injection of additional capital in that market. And I will tell you that we have actually reached a lot of clients, and the repayment rate is 100%. So our loans in Myanmar disaster right now are over $1 million from about March this year. So we actually see that in 6 months, we were able to reach $1 million worth of recovery lending, and we are still at 100% repayment. And we also see that recovery lending reduces defaults and also protects or even enable people to acquire new assets. But we know that in recovery lending, sometimes there's covariant risk that happen, or the shocks, aftershocks can come and affect the same clients. So we see that insurance plays a role as well in recovery lending. It actually helps people to smoothen their consumption. And also, if you are linked with enhanced credit life, which covers disasters, you can actually reduce the repayment burden from the clients. And we can also use insurance as an anticipatory action, so that you know that in a given country, there are typhoons or there are earthquakes. So once you actually know that, and you can actually create an insurance cover or even a meso-level cover that will enable you to inject liquidity in the event of disaster happening. So we believe that recovery lending works very well backed by insurance. So I think we are advocates that, yes, recovery lending is good, but it's not sufficient on its own. It needs also insurance protection over and above the credit that we provide. It is financially sustainable. All our recovery lending products have been able to cover their costs fully. And by stimulating economic activity in a given area, recovery lending supports all the other downstream industries and can enable a community to recover fully and faster. Thanks, Michelle.
Thanks, Ndumiso. So before we go on, I just want to open it up. If there's any questions at this point, 1 or 2 questions for Ndumiso, feel free, put your hand up. Yeah, I'll give you a few seconds if there's any questions that want to come through here in the front.
Yes, hi, good afternoon. Thank you so much for the very tangible presentation so far. I have a question about...
Yeah, thanks again for very tangible user cases you presented. Very insightful. I had a question about the insurance part. Could you perhaps elaborate a bit on how this is structured with your organization? Is it an integral part of the products you provide, or is it separate? And yeah, how is it structured? Thank you.
Thank you very much. A very nice question. And yeah, we have insurance differing with different contexts. In some countries, we actually provide our credit with what we call enhanced credit life. So the credit life will be the normal credit life we know, but we talk to the insurers and we add other benefits such as fire cover, we insure against drought, we insure against floods, and so on. So in the event of a trigger, the clients actually will have maybe 3-4 months of installments covered by the insurer. And in some cases, like in Malawi, there's also a cash payout, which actually helps the client to survive and have their livelihood immediately after the disaster. So yeah, that's one way. And we also have other newly designed insurance products. We have what we call climate cash. If there is excessive rainfall, our rain cash will give you an immediate payout without a physical assessment of damage or anything, but the trigger will be based on the amount of rainfall or amount of flooding or amount of heat. So we have various insurance instruments that we use to bundle together with our recovery lending.
And I'm gonna take a moderator's kind of jeopardy here and just go ahead and say that Vision Fund has also experimented a lot with the meso-level insurance. So kind of, having this kind of portfolio cover that they can step in at any country if there's a certain level of trigger. Next question.
Thank you. As my colleague said, very interesting. I was just wondering, how do you, forgive me the word, how you make sure that all the vultures stay away? So if you know what you said, in serious problems, then many leave because the disaster occurred, but then they see you're successful, so they think, okay, I'm trying to get my loan back. So how do you make sure that your good money is not wasted on bad money paying other loans? Do you have intercredit agreements? Do you make arrangements? Are you organizing with several lenders or funds?
For now, the pilots that we have done, we have been doing them on our own. But I would say our recovery lending is relationship-based. We get our credit officers to tell us about the clients that they know who are good clients. And even after giving out the loan, we don't stay away from the clients. We actually increase the frequency of follow-up visits so that you actually get to know what is happening to the client on a day-to-day basis. And I think the motivation on the clients themselves to keep the money and repay Vision Fund is even more, because they actually know that Vision Fund has managed to stick with us even during the times of trouble. And that in itself has actually seen us being approached by other non-clients saying, oh, we also want to come and benefit from Vision Fund. But our recovery lending primarily starts with our existing clients, and where possible, we then extend to new clients, which is what sometimes leads to growth.
Thank you. So with that, I think we'll change gears. We'll move on. Thanks, Ndumiso. We'll move on to David. David will talk about his company at Tram. As I mentioned, it's a climate fintech, and they're currently in the midst of a pilot with Banca Mia and BBVA Microfinance Foundation in Colombia. Talk about that and talk about the rest of the business. Over to you, David.
Hi. Thank you, Michelle, for the opportunity. Thanks, everybody, for coming, and thanks, Ndumiso, for the inspiration, right? I mean, this is fantastic that we have this evidence to sort of counter these myths on what works and what doesn't work. I find it always inspiring when I hear you speak. So go to the next slide. Since you're in this room now, you probably know that climate change is happening, right? And it's a major global risk. You see on that small little thing is been rated the top global risk by the World Economic Forum. And of course, if it's a major risk for big players like that, imagine for the small businesses we all serve, right? Up until recently, we didn't have very much information on how it is affecting. There's lots of anecdotal, but not a lot of hard evidence. This year, we had two pieces of information come out, the Findex 2025, and also a report from CFI Action on how micro-entrepreneurs experience, how often these weather shocks. And it turns out both sources are pretty much in agreement that across the world, on average, people are saying that they get hit once per every 3, so 33% of SMEs get hit once per year. So doing the math, roughly, that equates to 10% of SMEs being hit every year. So that's quite a bit, particularly because they're very vulnerable and they're very unprepared. So the question that we set out to answer, try to answer with that Tram is how could you lend in this environment where people are getting hit by extreme weather 10% of the time, right? Or 10% of them every year. And if Ndumiso has put a lot of evidence on the table on what happens after the disaster, what we're trying to do is intervene before the disaster hits. We have some initial evidence, not as thorough. I would kill for your type of data. Go, Michelle. So how could we do a better customer journey, right? That is not reactive and only kind of steps in after. And there's some recovery lending being done. A lot of lenders don't do anything in particular. As you were saying, they try to collect and pull out. That's even worse than reactive, right? So we think with technology improvements, there is a window to act before say the flood or the heavy rain comes. And what we do at Tram is build technology to help both the end user, the client, the borrower, and the financial institution be better prepared, identify the risks better, manage them, and reduce them. So I'll walk you quickly through the journey we're building. We'll divide it between before and after, right? So as you see here, before the disaster, we want to start the customer journey at origination time. Right now, very few institutions are pricing climate risk in their underwriting process. We think that should be something that needs to be done. It needs to be recognized that there are losses being caused by climate change, so let's put a price on it. And individuals, as they subscribe, they start their loan, they would pay a small 1%, 1.5%, 0.5% bundle fee into a protection pool that we'll talk about in a moment. But as they do that, they also receive from us a full climate risk report on what are their vulnerabilities, what are their plans, what should they do if a heavy flood comes, and things like that. So they're also protecting themselves, right? And basically that's what we do at the outset. The data against us 10% get hit, right? So over the year, as the loan unfolds, 10% will receive a WhatsApp message from us saying, we're so sorry to tell you that a big storm is coming your way. Will you still have some time to prepare? These are the things you can do. And our intention, we haven't done this yet, we're going to be piloting in Kenya in a few months, but our intention is to say, we'll pay you some money to put together the sandbags or to move your inventory up the shelves or to evacuate it or whatever. Because remember, everybody's been pitching in 1%, but only 10% of customers get hit. So we can focus the money on those that are going to be hit. Now that we know, at Iterating, we have a meteorologist on staff that is looking at all these different sources of weather forecasts. So the idea there is to incentivize first with an early warning message on WhatsApp, and then with money on the table, and potentially with the clock loan that Michelle was talking about. We call it alarm clock. Alarm for wake up, the storm is coming. Clock, I don't think they'll ever hear that word, but contingent line of credit, right? The idea there is that the bank is sending you this message. Like, we are in this together, you have my loan, I want it back, and I want you as a business to keep thriving. Ideally, you don't even need recovery if you prepare properly, right? But if you need some liquidity before the event, here's an emergency line. But again, ahead of the disaster. The literature from the NGO world, the humanitarian disaster world, puts a very high multiple on the return on any money sent into a disaster ahead of the disaster. Like 5 to 15 times. For every $1 that you give someone before a flood, they save $5 to $15 in losses that they don't incur, right? So there's a very high impact multiple that we're trying to activate. We really are, and this is something we're working on. We're not perfect, but we really try to get in this second step, get the small business or the farmer to prepare. And if they're prepared, they'll be hit a lot less, right? Then we move to, sadly there is a disaster, we move to the third step. At that point, maybe they need restructuring, maybe they need rescheduling, maybe they did prepare and they still got hit so hard that they lost their business and they need a write-off, right? But that's what the 1% that everybody was paying at the beginning is for, to cover the financial costs of the institution for executing these changes in the loan agreement, right? And they can ideally also get a recovery clock, the way Indumiso was describing it, right? And then at the end, during the recovery, as you see here, this pool of money is covering cost of the FSP up to a certain level. And then hopefully the business is recovering, is doing better, and the situation is much better. Like, preparation is really important, as you know. The problem in the past is, why should I prepare? You know, I'm a small business, I have so much going on. Is it gonna rain? I don't know, but you don't prepare. You wake up in the middle of the flood. But if you do prepare, you save a lot of your assets, and your livelihood, therefore, is better off. So now I'm just gonna go very quickly through the different steps. As you saw before, we want to offer support to the FSPs end-to-end through the life cycle of the loan. Climate intelligence is one layer. This is where we're bringing the pricing of the risk initially, triggering alerts both to the end user, but also to the loan officers who are in the same communities, right? And to the how do you call cobranza? Well, the teams in the FSP that chart. Say what?
The recovery team.
The recovery teams that recover the loan, and so the institution also needs to be alerted, right, to be most performant. And then there's reports, and eventually we can easily produce regulatory reports. In some geographies, like Colombia, for example, we're active. The regulator is starting to require FSPs to identify and report on their climate risks. So you see here on the right, the alert manager. That's the tool that our meteorologist uses to send alerts at a municipal level, super tailored, personalized to the persons who are receiving them. You can go to the next one. This is the climate protection. So there was the climate intelligence, which is essentially information. The climate protection is this protection pool, is money that gets set aside at the beginning of the loan cycle to cover essentially three things. We already talked about two of them. One is putting some incentives on the table for the end user to prepare, to activate their preparation journey, to take it seriously. Like, if the bank is sending me money, this must be valuable, right? This must be serious. And the idea here is that, you know, if they prepare their sandbags, we'll give them $5, right, or something. It's really to get them going. The second bucket is there to protect the losses that we were discussing before, from restructuring, rescheduling. And there is a third bucket that can be used to purchase insurance, because this works for your average year. If you have a really bad year, your losses would be higher than that 1% maybe that you collected on average. And that, for that sort of outlier year, support from an insurer is really what makes the most sense. Okay, go to the next slide. What does this look like from the perspective of the end user? Well, it's kind of basic. Is your WhatsApp. you are getting a WhatsApp message saying, Dumizu, your farm, so sorry to tell you, it's going to rain so much. Start getting ready, and you can check back. You can have a conversation with the AI agent that is powering that channel about what to do, how to do it. I'm sure most of you, maybe you don't tell your boss, but most of you are using ChatGPT for this or that, right? This is the same. This is why not lean on an intelligence that can help you with any hitches, with any ideas you need, with any support to get ready, right? And so everything really happens over WhatsApp, which is really where these clients are. They're spending their time already there. You go to the next one. As I was saying, we are now doing a couple of pilots I'll talk about in a moment. We ran an initial pilot in Kenya last March to May, which is their rainy season. And I won't go over all the numbers, but we're very pleasantly surprised by the results. A lot of users, when they receive an alert, actually do something about it. I think it was 75%. No, sorry, which one? Or 100%. Not surprisingly, women were both more frequent users, and they actually spend money preparing, whereas men were less frequent. Looking at you, Tamara, here, and didn't spend much money on preparedness, but we're working on them. Let's not lose hope on men. And what we were very happy to see is that when we call them after the alert, and we said, "What do you do? What do you estimate you saved because of the action that was triggered by the alert?" The result, as you see on the corner, is $77 that were saved. These are very small businesses, so this is a sizable portion of their inventory that was not lost because they acted based on our alert. If you go to the next slide, this is my last slide, I promise. We are, as Michelle was saying before, we're live right now in Colombia, working with Bancamea, which is a fairly large bank of 1.6 million customers. And we're essentially trying to test the business case, right? How is Bancamea benefiting if their users are alerted and prepared? And we will be launching a pilot in Kenya, another pilot in the next rainy season in March, activating this protection pool I was discussing before, putting some incentives on the table for the end users to act, and we'll see how well they do that, right? And I think that's it. If you go to the next one. Yeah, if anyone is interested in trying something like this out, our robots work endlessly, never complain, and they speak a lot of different languages. So come talk to us, and we'll love to learn more.
Thanks, David. Any questions for David?
I explained it so well that there's no doubt. Sure.
Okay, last chance. Any questions? And any questions online, or we good? Okay, great. Perfect. So what we've done so far is we've focused on kind of these two products that MFIs can launch, basically both into like recovery lending just afterwards, clocks beforehand is very new, and the use of AI to kind of decrease the risk around that. What we're going to do now is to switch to Tamara. Tamara's going to speak to us a little bit around how they're thinking about this from the investor's perspective and the types of products that they offer their MFIs to help them help their customers become more resilient. So over to you, Tamara.
Thank you. Let me stand up. I need to move when I speak.
Yeah.
And let me start my presentation. Welcome, all of you. Thanks, Michelle, for organizing this panel, and thank you both for this presentation. So I was hearing what you were saying, and I was, right? Right? For the ones who don't know me, I'm Tamara Campero. I'm the investment manager at Oxfam Novib. I oversee the impact investments that Oxfam Novib has. You might know Oxfam Novib is a foundation. Our investments are managed by a triple jump. I have Christoph there in the public to support us. Let me start and telling you a little bit about, our fund, but not this one, the next one.
Point that way.
wait a minute. Yeah. So Oxfam Novib Fund. Our fund started operations in 1998. We've been there for ages. It's managed, as I mentioned, by Triple Jump since 2006. For the ones you don't know, Triple Jump is a spin-off of Oxfam Novib. As I was saying, we've been there forever, always working on a financial institution, and we grew with the sector. In 2020, we felt that we needed to adapt, we needed to evolve, we needed to change, but because while we were doing was fine, we missed something special that we could provide to the sector. And also based on what you already mentioned, we felt that we could do something more than what we were doing so far. So what we did, we changed. We have a fund of 44 million, fully dedicated for financial inclusion, and we switched the strategy. So we don't do microfinance standard anymore. What we do with our funding is we try to support financial institutions to support their clients to become more climate resilient. So how do we do that? What do we mean with that? So to do so, we decided to adapt our offer. So what we are doing at this point, we created 3 different credit lines. So we changed the offer that we provide to our clients. On one hand, we provide a resilience funding, and that is special funds to financial institutions operating in highly vulnerable countries of areas to climate change. We also have, and this might trigger you, the other investors, we also have 10% of our total portfolio dedicated to recovery finance. So that means we do provide funding post-disaster. And we have another credit line dedicated for innovating. And we call it the Innovation Lab. What we do with that is supporting the seeds of new products. So we provide fine-tuned support, can be guarantees, can be soft loans to MFIs to improve, to innovate, to develop new financial products. Always the products need to be focusing on increasing the resilience of the end client to climate change. Next to that, next to the credit lines that we also offer capacity building. We don't have large amounts of capacity building. We don't think that that is our role anymore. So we engage with partners and try to use the small amounts that we have for capacity building to do 2 things in principle. We are convinced that a financial institution needs to improve the climate risk awareness that they have. They need to be aware of the real risk of climate change. And by real risk, I'm not mentioning, okay, that crop is vulnerable, of this area is more vulnerable to floods. By assessing the real climate change risk, we're talking about everything. Operations, the risk of the end client is having, and of course, portfolio. The second type of support that we provide to our clients is once they have improved their risk awareness, we help them to develop new products. Always based on this research that they do. So while we do so, we hope, we expect our clients to first really assess their risk to climate change, And once they are aware of the risk, we hope, we expect them to embrace the risk and start to see this risk as an opportunity as well. While they develop new products, they could still reaching those clients that they were not reaching anymore because of the high risk. So that is our theory. Another thing that we changed is our selection criteria. And that is something very important, I think, so when you are changing your offer. We used to work, we are a worldwide fund, so we have certain countries that are priority or not for Oxfam. But what we did is nowadays we select the countries in which we work based on the climate vulnerability of the countries, because we want to work in the top climate vulnerable countries. So we combine two different types of indicators. With this, we are measuring, on one hand, the sudden risk of climate disasters, and also the long-term risk. Combining this, we made a list of countries where we want to work, and we start to targeting MFIs in those countries. So years ago, we focused on the most tier 3, tier 2 MFIs, the most vulnerable, the ones who were were growing. At this point, we changed that. We believe that we should be supporting MFIs able and willing to innovate and to support the end clients in a better way. So why we're doing all this? This is why. And let me introduce you Ruskana. Ruskana is a farmer in Pakistan, and she was badly affected by the flooding. As you might know, climate change is aggravating already existing inequalities and vulnerabilities. The gender aspect of climate change is huge. We felt that we needed to make that move to be in line with our mission, that is supporting the end client. It was very, very nice to see your presentation, Vision Fund, mentioning all the misconceptions that you have about recovery risk finance and the risk, and we see that as well. We think that on one hand, you see these preconceptions, this vision about how is investing in highly risk areas, from the MFIs to the client, but at the level of the impact investors, we all have the same misconceptions. We all think that once a disaster has occurred and several of our clients in a country are affected, it's the moment to stop, to close the funding sources and to start to recover our loan. And that is not, in our view, that is not the solution. That is only generating more and more problems for the MFIs and, of course, for the clients behind. So based on these new products, new offer that we have, and this in place since 2020, I would like to tell you a little bit more about a concrete case in Pakistan. So some of you might know SAFCO. SAFCO is an MFI in Pakistan. It's a regulated one, and it's a long-standing client partner of Oxfam Novib Fund. Pakistan is affected, severely affected by climate change for years, for decades. In 2011 and in 2022, they were affected by flooding, droughts, heat waves, and so on. So why we invest in Pakistan? now that you know how our selection criteria is, I think that it's clear why we are working with SAFCO. Because this MFI was already so aware, yeah, they've been affected in one way or other for decades of climate change. They were already searching for some options. So what we did, we provided some funds to them for the innovation lab. That means we provided some funds to innovate, to test new products. And we also, yeah, that was also part of our mission. Do not forget, 10% of our portfolio is dedicated for recovery finance. At the moment that we were working on the credit line 3, the innovation part, they were affected by a new flooding. So they also received later on another loan for recovery. I will tell you more about that. So with the innovation funds, what we did, they were already working on a risk assessment of their clients, the agricultural ones. So they find out that there were special problems on agriculture and livestock products. So with our support, and we worked also in partnership with the Pakistan Microfinance Network, they did the risk assessment, they did a market analysis, and they designed this new product. So on one hand, to cope with the risk at agriculture, they launched this loan bundled with crop insurance. And within this project, they also improved another loan product that they had for livestock. The results of this lending, because at this moment the portfolio has been repaid, and the results in terms of portfolio quality are exactly aligned with the figures that the Vision Fund was sharing. We had 0 par for that portfolio. Now, talking about what was our other option, or our other offer. So they were badly hit by the flooding. And at that point, what we did was, okay, the first thing that you need to do as organization is to assess the damage. Prepare an assessment of your damage, tell us how badly it was affected, and tell us how can we improve, how can we help, and then we will be disbursing the recovery finance. And that's what we did. So we provided also a new amount of loan on the top of the loans that we had for them to disburse new loans, top-up loans to the clients that were affected by climate change. At this moment, also that portfolio is already closed, and guess what? Again, 0 par. So the figures that were already shared are proving also, are seen also in our portfolio. Now, at this point, so we have with this specific client two pilots, so they received the funding to pilot this product, and they received also funding to recover of the crisis. At this moment, we are working on one evaluation. Why? For us, as Oxfam, it's very important, of course, to see the real impact of these 2 credit lines that we have and the life of the end client. So we're working on this part. For SAFCO, it's very important because the reception of these new 2 insurance products was very good. So what they want now, with this evaluation that we are doing, they want to fine-tune the product, and they will launch on a scale-up of the pilot. For this, they don't need any more special funding from us. They are willing to launch the second phase of this pilot with their own means. So with this, I hope that I have provided you with some more insights of what we can do as investors. I think that we believe, it's not that I think, we believe that financial institutions have a role to play for the climate resilience of their end clients. And we, as investors, as social investors, have also a role to play to support them. So you can see, it's very important, the fine-tuning of the funding, the adequation of your offer to the changing environments is crucial in this type of situations. That's it.
Thank you. Thanks, Tamara. So I'm going to open it up to the floor again. If there's any questions for Tamara or for any of our other speakers, please feel free. I have some questions of my own, but yeah, there's a time now. Howard.
Thank you, Tamara. Where does the funding for your fund come from? Who invests in your fund?
Oxfam Novib.
Only Oxfam.
Maybe something to add about that, because I was presented this new strategy for a group of bankers, social investors, and of course you get the next question is, okay, and what about your results? You're taking a lot of risk on it. Let me tell you, we're having the best years in terms of financial results as well of our last 5. So it's working. It's also part of risk management measure that you keep on supporting your client in terms of problems.
Could you do more with a bigger fund if, say, a DFI put money in and...
We would love to. You know, it's part also, because we are a foundation, we are an NGO, we see our role as influencing other investors. And for sure, if we are reaching the results that we are reaching after 3 years of implementation of this strategy, I'm sure that we can rock with more funds. Yeah.
Thank you. So I'm actually going to read a couple of questions from one of our online participants. His name is Marcelino from Good Neighbors. And he has first a question to David. He says that you had mentioned about recurring to reinsurance to counter volatility of events. If you could please elaborate a bit more on that. And then another question to all speakers. Do you, in some of your projects, bundle climate insurance, and do MFI members appreciate it? Thank you.
I'll go first. Thank you, Marcelino, for the question. So the idea here, as Ndumiso was saying before, is to apply a meso-level insurance lens, right? At the beginning of the year, you may be able to do some forecasting 12 months into the future on how the year is going to be, but that's the hardest type of forecasting, right? So it's not going to be super good. So you need to price the risk based on maybe your average year or some prior level. It could be that it ends up being a very bad year, right? Or it could be a good year. And you just don't know. That's the volatility inherent to the weather, right? Thankfully, not every year. I mean, it does feel like every year is worse than the one before, to be honest. But that's probably not true in every country all the time. So the idea here is that to protect the pool, the institution, as well as the clients from the worst years, one slice of the overall protection pool is used to buy insurance from someone who can say, yeah, put in $1 million here, say, I'm making numbers up. If it's a really bad year, we'll pay back $5 million or something. But most years, you won't get any money back. So the one time you do get hit especially bad, you have more money to cover costs, to write off loans, to do all of that. So it's a meso-level insurance policy. That, with the intention there that being meso-level means it's more efficient, right? You get more done with the same amount of money. I hope I answered Marcelino's question.
Yes, I think David has said it all. But what we also find with MFIs is just the same as clients as well. If they buy the policy this year and nothing happens to them, they feel they have not benefited from their money. But with insurance, you know you can run for 3 years and only benefit in the 3rd year. So that insurance education is needed at both client and at MFI level so that they know that it might not happen to you this year, but happen to your neighbor. And then after 3 years, you might still have not benefited. And then you get hit by a huge disaster in the 4th year. And then you get a huge benefit, which actually is much more than the investments you have done in premiums for the past 3 years. So yeah, insurance works like that, but our MFIs and our clients still need a lot of education to understand that even if you don't claim, don't start saying, oh, I want my money back, no disaster happened. It's covering you for the future.
Yeah, I cannot agree more with that point. I think that, and it might be ironic what I'm about to say, but on one hand, and when we're talking about on client level, I think that financial literacy and awareness about the benefits of insurance is huge. You really need to do that. And on the other hand, there is no better marketing for insurance, especially this type of products, that's a shock, that a flooding, and that is happening every year, coming back and coming back. So what we see is that more and more MFIs and end clients, because they are already hit by a disaster, they are considering this type of innovative products as a need.
I'm gonna kind of push back and ask our experts another question here, which is, how much can we expect from insurance? So we've seen, I guess, over time that demand for insurance just kind of, systematically or over time is very low. Subsidies, when subsidies are taken away, it's low. And I guess my question that I've been playing with a little bit lately is, how much can we expect of it? So if it's not, a lot of the examples we've given now are either at the meso level or they're mandatory. So like that question around mandatory versus voluntary, meso level versus customer level, and then the last one I'll put in is around what do we expect insurance to play? So I've been thinking of insurance more as a way to get a person back in the game, as opposed to a way to make a person whole again. So like, I want my insurance to make me whole, like I want a new car if my car gets written off. I don't know if we're in that same environment where someone can put aside enough money ex ante for one risk that will make them whole again. So that's kind of some thoughts. Just wanted to open up for the audience as well for the speakers to comment on.
I can take a first stab. I'm not an insurance expert, so I hope I'm not putting my foot in my mouth here. But I think, of course, the risks are growing and changing in a way that all your actuarial data from the past is less valid than it used to be. So that must be a little scary, to be honest, for them. Our proposal to the marketplace is that maybe insurance shouldn't be just passive, waiting for something to happen, maybe some parameter hitting and then sending money. Like, why don't you prepay on your payouts? Because if you prepare, and again, sorry, go back to my example, you move your inventory out of the way, you may not lose it, and then you not need to claim. Right? So maybe a little bit of smart money being deployed at the right time when the stakes are high can actually lower your payout significantly. And insurance has not really done a lot of that. There are some examples. For example, I know of a case in Canada where a big national insurance company was working with a AI weather company to send alerts to their customers when a hailstorm was coming to town. And all they did is, okay, here's a message, okay, sure, let me park my car somewhere else. And they move the car indoors or they put it under something, and they saved millions of dollars because then the hailstorm was not breaking the car windows or whatever. it's pretty obvious. If something's going to hit you and you protect yourself, then you claim less. So maybe insurance has to evolve toward that proactivity level. Otherwise, it's going to be increasingly expensive. I don't know who's going to be able to pay in general.
Good example. Thank you, David. I want to go back to the audience. Any more questions from the audience? Okay, so what I'm going to do is I'm going to ask you that we wrap up a final comment. And I guess the direction I want us to take it is almost what's one thing we could do to scale up. We've heard some good examples of, lending into, we know it's needed, we know it's having impact for customers, and we know there's ways to do this profitably. So what's the kind of one request, whether it's for funders, whether it's for investors, whether it's for MFIs themselves, what's the one thing we can do to unlock and scale this kind of ex-post liquidity?
Yeah, thank you, Michelle. I think as we all see, I think everyone has a positive view of recovery lending. And as I said in the beginning, good clients will always remain good clients even in times of disasters. What I'm going to say is that for MFIs to be able to effectively scale recovery lending, we need to have financing facilities. So we need investors that will be ready to put money into recovery lending. It's not only helping to impact clients, but it can also be good business, as this money can be paid back to you and cover the costs of distributing it. So we need actually to have more money going towards recovery lending, and grants are shrinking, and therefore we need more investments going towards recovery lending as we go into the future. And I think that's the mindset that we need to have as MFIs, as investors, and also the insurers need to see this as a growing business that will then have a positive impact on our clients.
Thanks, Ndemiso.
Should I go? So we definitely need more money, obviously. Whoever has any extra change on their pocket, let us know. But I think collectively what we've seen today, recovery lending on one level, what we're trying to do, anticipatory lending, what you guys are doing with the different layers, this is a new category of financial products, I think. Let me be provocative. I would call it extreme weather finance or even extreme finance, which sounds really cool. But I think we need to realize that climate change is a different risk from what we've seen in the past. It's only going to get worse. Last year was the worst year ever in emissions. So we're going to have a good number of years where every year was worse than the one before. We're talking decades here until we start fixing this problem. And we need to start, as you were saying, innovating and figure out how do you change the loans? How do you change insurance? How do you change savings so that they're ready to be and they're climate smart? And I think putting a name on the effort will be helpful because then we know what we're talking about. Climate finance is a very broad term. You have things like renewable energy and carbon credits and completely, it's great. It's a great tent of the work. But for physical risk, which is a moment in time where the stakes are really high for those individuals. Really high as in you could lose your life. Right? We didn't talk about that, but it gets that bad. How can financial instruments be ready for showtime right before, right during, or right after such a high-stakes moment to not only support the users with the tools they need, but also to send the signal, be ready, this is serious, right? It's very easy to go into alert fatigue, or yet another alert, they're telling me again it's going to be hot, okay, I live in Madrid, of course it's hot, right? But now sometimes it's very hot, and you do need to act on it, right? So I think calling it something, if others have better names than extreme finance, we're very happy to hear them, but may help us all get into sort of the same mental bandwidth.
Yeah, let me organize. I fully agree with what was said already. Yeah? Let me organize a little bit my answer. I think that we can answer in two levels. When we are talking about what is needed at the financial institution level, I think that really climate risk awareness, climate risk assessments, but the real ones are crucial to move forward. and the fine-tuning of the offer that we all, at all levels, we impact investors, financial institutions, the fine-tuning of our funding, it's crucial. I think also when we are talking at the end client level, but your work is also related with that, the early warning systems, and it's part of climate risk awareness as well. But I think that works very well. At Oxfam Novib, so Oxfam is a foundation, and we have one of the areas where we work is financial inclusion, but we are also experts in the humanitarian work. And Oxfam Novib have been testing for years these cash transfers, exactly with the figures that you mentioned, with the idea that if we provide cash before the disaster, then we are actually saving some money that we can use for other situations. Also, the early warning systems, there are really nice examples of early warning systems that have been started in the Philippines, for example, and at a certain moment the system was adopted by the local government. So I think that is also crucial at this point.
Great. Well, thanks, everyone. I think we've heard it. It sounds like a combination of kind of innovation and technology in order to prepare and decrease the risk, as well as fine-tuning some of that funding that both goes to the MFIs and that eventually goes to the customers. And then while we're rolling it out to the customers, I guess staying as close to them as we usually do. So thanks very much. I'm going to offer, please give a hand of applause to our speakers. Thank you to our audience online, and to those in the room, feel free to grab them afterwards. I'll volunteer their services to you. Thank you.
Thank you.
Thank you, Michelle.
Thanks, David. Nice.
Nice to share.